Hey everyone, welcome back to the Your Money Life podcast. We're on episode 334 of the podcast. Do me a favor, wherever you're listening, you like, subscribe, five-star rate, and review this podcast. Let's jump into it first by looking at the market and what the market is telling us this week. First and foremost, the last five trading days have been relatively positive, up over 2% in the last five trading days. We've had some decent news, decent recovery, decent bounce back for the market here in the last five trading days. Again, we're opening the market roughly flat on the S&P 500. It's showing that will be a little bit higher to flat as the indication in early morning trading. We'll see how that holds during the day. If you pull it out a month for the chart, on this SPY S&P 500 ETF trust, we are actually looking at down a little bit over 1%. So nothing crazy. Again, summer is usually a slow time for the market. If you think about when people go on vacation, summer, you got those winter times, or it doesn't mean it's slow, but people go on vacation. But summer vacation is really popular in the finance world and for traders. And so you're going to see slower times here during that. 6 months up over 8%, nearly 9%. 1 year, 21%. Folks, 21% over the past year just on this S&P trading S&P 500 ETF trust. It's just showing that again, showing that being invested for longer term is incredibly beneficial. And so you're seeing this in the data, but people will still mistake the data because they want to day trade or trade and try to get in and out. Not worth your time, truly not worth your time. Do you want to look at any others? You got the Vanguard VOO. It's going to show similar numbers, literally. It's just another S&P 500 ETF tracker here. So we're seeing all the same stuff, ladies and gentlemen. It's really, really, again, been a strong time for the market in general and for the people that have been investing. And so that's why you want to invest for longer term versus trying to day trade and trying to beat some metric that is just not really conducive to your long-term viability. So I'm just going through different large cap ETFs that are showing similar things. You have the Charles Schwab one as well, that track just the large cap companies, and large cap companies are doing incredibly well, which we know is mostly filled with tech. So that's something to note. Let's go to news. There's a hiring shortage. The hiring shortage is a bigger hurdle for Gen Z than AI. So they're saying hiring shortage is a bigger hurdle for Gen Z than AI. A shortage of job openings in the US is a bigger factor in unemployment among Gen Z than their level of proficiency with artificial intelligence. This is from a new study from the Federal Reserve Bank of St. Louis. The unemployment rate among 18 to 24-year-olds rose 2.9% due to job scarcity, compared to the 1.1% increase attributed to employers pivoting to more AI focused jobs. The study found that lack of openings still had greater effect among recent college graduates than AI related job demand. So interesting. Interesting. So we're saying that there's just not as many jobs out there versus companies just pivoting to AI. There's just, if you think about it, we are at what unemployment rate of in the 4% range, right? And that's usually typically 3 or 4% ranges is about as good as it gets for unemployment. You're not going to have 100% employment. You're going to have some unemployment, obviously. And so, with that said, they're pretty much saying there's just not many more jobs. I mean, we have to grow. You have to have growth. You have to have companies growing, companies doing better for there to be more jobs available. And we do have growth, but I guess we're all filled up, and it's really hurting Gen Z and people that are just graduating because they're looking for opportunities, obviously, to get into the workforce, gain experience. And now we're saying we first you said AI, now we're saying there's just not many jobs left, not jobs available. Um, so that's not a good thing. Of course AI is an additional headwind, but they're saying the effects remain smaller than the broader decline in job openings. But I guess what is the reason there's a decline in job openings is because of they're using AI more efficiently, and they have, that's just another chicken and the egg thing where we keep going back and forth with it. Um, the study also follows one more Federal Reserve Bank of New York that found the culprit for young. So this study, the St. Louis one, follows the one from New York that's also found another culprit for youth joblessness beyond AI, and that's remote work. So they're saying that remote work that the younger people want it, or that remote work that it's hampering opportunities. That's interesting. That's interesting. So keep your eye out if you're young Gen Z. Make sure that you're doing everything you can to increase skills. Speaking of skills, I don't know if you people you're watching the FIFA World Cup. I'm like so intrigued with this year. I am really into it. I've been watching as many matches as I can, but which is not that many full watching live. But the YouTube recaps, those are perfect. I started getting to the YouTube recaps with NBA and FIFA and soccer. Well, it started with NBA. Just they cut it up, they edit it. It's perfect. You just get to see the highlights. 20 minutes long, 15 minutes long. You don't have to sit down for a 2.5, 3 hour game. That's perfect for me, especially if it's a team that I'm not really something I'm not really that into, but I just want to watch and be informed and have some entertainment. That's perfect. You're walking, can watch a highlight. But we did watch a little bit. My wife and I watched a little bit of the game yesterday when we saw US take the lead. We were kind of convinced they'll be able to hold on, and they did. They scored again, and now they're going to the round of 16, and they're facing Belgium. And I think right now they're favored over Belgium to win. And so that's pretty interesting. I think there was also a story about the World Cup. It's estimated the World Cup is going to boost the June jobs report by 40,000. This is an estimate from Goldman. They said their Thursday could be the June jobs report on Thursday could be more robust than expected due to a strong kick from the World Cup, according to Goldman Sachs. Goldman said the home base data suggests that beautiful game had at least a modest impact on hiring, contributing up about 40,000 positions for the month. So we did see that new farm rolls are projected to post a gain of 150,000. And let's jump into that projection here. So the June job report is due out Thursday today. For people that are listening as soon as we release this episode, it's a day early thanks to 4th of July. The economists project the country added 115,000 jobs for the month, keeping the unemployment rate stable at that 4.3% that we were talking about earlier. And job growth has been relatively healthy so far in 2026, but the gains have mostly been limited to particular sectors. In May, for example, more than half of the new jobs were in just two fields: food service and local government. So private sector unemployment figures out Wednesday from ADP, meanwhile, showed most new jobs came from the healthcare field. Interesting, interesting. So we are going to see if we get the 150,000 new jobs added in June. That number will be out shortly. Again, the Goldman saying, "Hey, this a lot of it's boosted by the World Cup, like hospitality, leisure. There's a lot of stuff happening this summer. You have America 250, you have the World Cup, you have NBA Finals, New York. Everything is a lot of stuff happening." And in this Goldman report, they said their historical analysis suggests that the World Cup could boost payroll growth by 40K in June, and its impact could be concentrating in leisure and hospitality, professional business services, and trade and transportation. Consequently, Goldman expects a total non-farm payroll growth of 140,000, which would still fall below the pace of the prior month, but significantly better than the 20,000 jobs lost in June of 2025. So it's showing growth from last summer, where in June of 2025 we lost 20,000 jobs. They're showing a little bit growth. So again, the economy doesn't seem to be slowing down. I don't know if we can't really see the slowdown. There just isn't. Remember, we were talking about recession, recession, recession. Those concepts kind of quieted down. And it's just more like, hey, we're just chugging along and enjoying the summer of 2026 to best of our abilities. And so we'll keep our eyes on that. So we talked about the June news. And let's look a little bit back more into the stock market and what's actually trading or what's the themes that we're seeing. So this is an analyst saying that one of the characteristics of the bull market has been rotation. So they're saying a passing the baton to non-commodity cyclical sector would be further evidence that the stock market is entering the second half of the year in a position of strength and the bull market can continue. So they're saying if we could go from, you know, a passing the baton to non-commodity cyclical sector, we would be actually, it would be further evidence that, this is not just a one-sided or one sector showing strength, just only tech, that we're seeing, strength across the board. And that's something to be seen. So if we see more of the value companies, the stalwart companies that are in the Dow, start to boom and do well this summer to the end of the year, it's just showing that this is more of a well-rounded bull market versus just tech stocks and the big large cap tech really just booming forward. So we'll keep our eyes on this. Nothing crazy. Again, quieter summers, nothing crazy. Let's see if there's any other stories. There was a couple more that I wanted to make you guys aware of. Comcast and is gonna spin off NBC Universal. So Comcast shares their roles Monday on news that they're gonna spin off NBC Universal and Sky from its cable portfolio. The stock initially jumps as high as 25% early trading, with the deal leaving management to focus on its core verticals of cable, wireless, and business services. So NBC Universal and Sky will form a new publicly traded company similar to Versant Media, the holding company of CNBC and MS Now, that Comcast officially spun off in January. So Bravo, one of Comcast's most lucrative properties, oh, I think my wife attributes to that because she watches every one of the Housewives, will remain part of the NBC Universal deal. Interesting. She'll be interested to know that. The Universal theme parks and studios will also come with the new spin-off entity, along with Telemundo and Peacock. So they're spinning off so they can focus and have a more centralized, logistically focused companies versus just like being a holding company of all these different assets. They're spinning off so they can really focus. And so I mean, the market, the shares rose. Investors are in favor of this, and it shows clearly based on the market. So that's something to keep watch for that. And CNBC and different things fall under these umbrellas. Here's another story. The gap between home prices and wages for adults under 40 is the widest it's been in decades. So, the long awaited housing bill aimed at boosting the housing supply and lowering housing costs arrived at the president's desk yesterday. And so, millions of people in the U.S. are concerned that the House legislation can't really come soon enough. With the nation's youngest would be when the with the nation's youngest would be home buyers locked out of the market by home prices that have soared. So, if I'm not mistaken, this is a bit a dated article because I think that um, legislation didn't pass because there was some other things going on. So it didn't pass. But people were saying there's a gap between wages and home buyers on home prices for adults under 40. It's the largest gap it's been in decades. And that would ring true when you're hearing people talk about these sort of things. So that's some interesting to note as well. Folks, let's go into the question of the week. And I think it was a good one because we were just talking about the market and how it's important to be investing for long term. But let's look at this question. It says, what has been the geometric average return? So geometric average return for the stock market over the past 50 years. And it stops the data at 2020, but it should keep going. Actually, I would love to see the full data. But what has been the geometric average return from 1970 to 2020? So that's 50 years of data. The geometric average return, I'm going to guess roughly 10, 11% or so. Past performance is no guarantee of future results, but the answer is 11.9%. 11.9% average return for the market. That's again average. So they're taking that year over year on year and 11.9%. So that's a crazy average annual return there. Um, if you think about it, ladies and gentlemen. So, it's just another a tidbit to say that you don't always have to have money in a savings account. You can invest. You should invest. You should get invested, especially for your longer term viability. That's the main reason why you should. And so keep that in mind as you're thinking about the things you're doing. Folks, we've onboarded a bunch of people, a bunch of creatives this summer. We're going to continue to do that. Reach out for that financial planning. Reach out to speak to someone to get an understanding of your situation and an assessment, analysis, an audit so that you can better your life in the future, folks. So remember, share this with your family and friends, like, comment, subscribe. We will talk to you next week.